Hey guys, welcome back to my channel. In today's video, we'll be talking about the Canslim Strategy by William O'Neil. William O'Neil's Canslim method is a method that he uses to invest in the stock market. Before we dive deep into William O'Neil's Canslim method, let's take a quick look at who William O'Neil is and why we should pay attention to his investing method. Early on in his career, William O'Neil managed to turn $5,000 into more than $200,000 in profits in little over a year. So William O'Neil managed to 40x his returns in the stock market in little more than a year. In addition, he launched his mutual fund, and after only 2 years, the O'Neil Fund became the best performing fund in the country. So these are some of the achievements that William O'Neil managed to achieve in the stock market. So what made William O'Neil so successful in the stock market? One of them is his Canslim method. The Canslim method is a method that William O'Neil uses to invest in the stock market. And this Canslim method includes buying and selling rules derived from an extensive analysis of all the greatest winning stocks. So what William O'Neil did was to go back in history and study all of the greatest winning stocks. And from there, he realized that all of these winning stocks shared certain similar characteristics. And that is how he managed to put his Canslim method together. Let's take a look at what this Canslim method is. The Canslim method consists of 7 main criteria. The C in Canslim is current quarterly earnings per share or EPS. A is annual earnings. N is for new products, new management or new highs. And for S, it's supply and demand. For L, it's leader or laggard. And I is institutional support, and for M, it's market direction. These are the 7 main criteria in William O'Neil Canslim method. The first criteria that we'll be taking a look at is the current quarterly earnings per share. For current quarterly earnings per share, we want to look out for EPS being up at least 18 or 20% in the most recent quarter versus the same quarter the year before. That means we want to see that the company's earnings per share to be up at least 18 to 20% year over year. And William O'Neil placed more emphasis on year over year compared to quarter over quarter. And the reason is this: he believes that quarter over quarter, performance are more likely to be affected by seasonality. But on the other hand, if we compare year over year, if there is fluctuation in performance, it is highly unlikely that it's because of seasonality. So for current quarterly earnings per share, we want to see an increase in earnings per share to be supported by 1. Sales growth of at least 25%, and then the second one, an acceleration in the rate of sales percentage improvement over the last 3 quarters. The reason why we want to see an increase in earnings per share to be supported by increase in sales is because an increase in earnings per share can be inflated by cost reduction or reducing of R&D. And these methods of cost reduction is not sustainable in the long run. A company can only cut so much in cost. But on the other hand, for sales, a company can always continue to grow its sales. And that is why that is more sustainable. So that is what we want to look out for current quarterly earnings per share. The next thing we want to take a look out for is when to sell based on this current quarterly earnings per share. We want to look to sell the stock when the company's earnings per share begin to decelerate and significantly slow down. For example, if the company's earnings per share was growing at a 50% rate previously, but now only growing at a 15% rate, then this could be a potential sign for us to look to start selling the stock. But preferably, we want to see 2 quarters of consecutive slowdown before we sell the stock. For annual earnings, what we want to look out for is that the annual earnings per share increase every year for the last 3 years. And we want to see positive annual growth rate over the past 5 years. The reason why we want to see these growth rates increase every year for the past few years is because this shows that the company has stability and consistency in terms of its earnings. And on top of annual earnings, we also want to see the company having a ROE or return on equity of more than 17%. The third criteria is new products, new management, or new highs. What we have to look out for in a company is that the company is introducing important new products or services. Or it can be a change of management or even a new industry conditions. So the best is that the company is showing all of these 3 signs. But minimally, we want to see the company or the stock showing at least one of these signs. The reason why we want to see a company introducing a new product or a new service is because this important new product or service will sell rapidly, which will cause earnings to accelerate above previous rates of increase. On top of new products and new management, we also want to see the stock making new highs. This might seem a bit confusing to some of you guys because for some of you guys, you are always told to buy low and sell high. But now the advice is to buy at new highs. So this definitely sounds a bit counterintuitive. But if you take some time to think, if the company and the stock is doing well, fulfilling all the criteria that we have went through so far, and having good fundamentals, there's a high chance that the stock price of this company will reflect these strong fundamentals. So according to William O'Neil, we want to look for stocks making new highs on big volume during a bull market. And on our price charts, we want to look for stocks making new highs as they break out of a price consolidation or base. A sound base, according to William O'Neil, is when a stock trades sideways or moves within a range for anywhere between 7 to 8 weeks to up to 15 months. And the pivot point, also known as the entry point, is when the stock is starting to break out of the base. That is when we want to enter our stock. If the stock fulfills the criteria in the Canslim method and is trading within a sound base and is about to make new highs, this is a potential pivot or entry point. But take note, we want to avoid buying once the stock is more than 5 to 10% above the pivot point. What William O'Neil is telling us for this point is that we do not want to chase the stock. If we have missed the entry point for the stock, when the stock has moved up 5 to 10% above the pivot point, we should let that stock go and look for other stocks, or at least wait for another good entry point. The next criteria in the Canslim method is supply and demand. What do we look out for in supply and demand for a stock? If all other factors are equal, the stock with a smaller shares outstanding will usually be better. For example, a stock with 5 billion shares outstanding will take a larger volume of buying or demand to cause prices to increase compared to 5 million shares outstanding. So we want to look for small to medium-sized growth companies that meets the Canslim criteria, and on top of that, we want to see its own management buying its own stock in the open market over a consistent period of time. By doing this, the company is reducing the number of shares in the market, and it usually implies that the company expects improved performance in the future. Right, because there are many reasons why insiders or management will sell their stock. But there's only one reason why insiders buy their own stock. They believe that the stock will perform well in the future. The L in Canslim stands for leader or laggard. When we are buying stocks, we only want to buy the leader in the group with the correct timing, because by doing this, we will have huge potential upside for the stocks that we are buying. The top 2 or 3 stocks in a strong industry group can have unbelievable growth, while others in the pack may hardly move at all. And that is why we only want to focus on the leaders. Market leaders are not the largest companies or the ones with the most recognized brand names. It's the companies with the best quarterly and annual earnings growth, ROE, profit margins, sales growth, and price action. So basically, all of the criteria that is mentioned in the Canslim method. So how do we find these leaders? The first way is to check IBD's or Investors Business Daily Relative Price Strength Rating. The second is to check the relative strength of a company. And the third is the beta of a company. For the first option, to use Investors Business Daily, you need to have a subscription with the company. But for the second and third option, you can find it online for free. So stocks which are leaders will show high relative strength and high beta. But take note, if you buy stocks with high relative strength and high beta, these strong growth stocks normally correct 1.5 to 2.5 times the general market averages. During a bull market and an uptrend, these stocks which are leaders will tend to outperform the general market averages. But during a bear market and a downtrend, these very same stocks will tend to underperform the general market averages. So the pros of owning these stocks is that during a bull market and an uptrend, these stocks will tend to outperform the general market averages. But the con is that these stocks also will tend to underperform the general market averages during a bear market or a downtrend. So for example, in a downtrend, the general market average will fall 10%, but these growth stocks will tend to correct 15, 20, or even 30%. So that is something to pay attention to. But with that said, these stocks which are leaders tend to recover faster than the general market during a bear market. The next criteria is institutional support. We want to look out for stocks owned by institutions such as mutual funds, corporate pension funds, bank trust departments, and educational institutions. Ideally, according to William O'Neil, we want to see a stock being owned by more than 10 institutions. For institutional support, we want to buy stocks showing an increasing number of institutional owners over several recent quarters. But with that said, too much sponsorship is also not good, because by the time a company's attractive performance is so obvious that almost all of institutions own the stock, it's probably too late. But we don't just want to look for quantity. We want to look for both quantity and quality in institutional support. We only want to buy stocks that have at least a few institutional sponsorship with better than average performance record, and invest in stocks showing an increasing total number of institutional owners in recent quarters. And for the 7th criteria, we take a look at market direction. For market direction, we want to look out for stocks that are in a bull market or an uptrend and in an early stage of the bull market. And the best way to determine the direction of the market is by looking at the general market averages. So we want to take a look at the 3 major US indices: the S&P 500, the Dow Jones, and the Nasdaq. These 3 major US indexes will provide us a good sense of what is the market currently doing. A point to take note about market direction is that the stock market anticipates and discounts economic events months in advance. So we cannot just make our investing decision based on what the economy is currently doing. Because like I mentioned earlier, the stock market discounts these events months in advance. So bull markets usually top out and turn down before a recession sets in, and bear markets usually end while business is still in a downtrend. In addition to taking a look at the general market averages, we can also take a look at the movement of industry groups, because this industry group moves at various stages of the market. For example, machinery and other capital goods industries are late movers in a business or stock market cycle. If this machinery and other capital goods industry starts to take off, chances are we are in the later stage of a stock market cycle. Alright, so these are the 7 criteria of William O'Neil's Canslim method. If you want to learn more about William O'Neil, check out my video after this where I share with you my learnings from William O'Neil's book, How to Make Money in Stocks. I'll see you in that video. To your financial success.